All right, welcome back to the deep dive. It's February 19, 2026. Today, we're looking at a stack of documents that, well, they paint a pretty stark picture of the North American landscape. We're calling this one the Great Divergence.
It's a fitting title. I mean, when you look at the data we have in front of us, investment committee memos, tax models, some heavy macro forecasts from late 2025, there is a very clear theme emerging. The analysts are calling it the Southern Drift.
The Southern Drift. You know, it sounds like a weather pattern, maybe a country song, but in this context, we're talking about billions of dollars in capital and, maybe even more critically, a massive amount of human talent moving from Canada to the United States.
Exactly. And the mission for this deep dive is to really figure out why. Is this just a temporary blip? Or, as some of these memos are suggesting, has Canada become structurally, uninvestable for global capital compared to its neighbor? Because the flow of funds over the last 18 months, it's not a trickle anymore.
It's a flood. That's the big question. And we have a lot of ground to cover to answer it. We've got modeled comparisons of industrial warehouses, Toronto versus Dallas, deep dives into U.S. tax code changes, and some genuinely scary risk assessments about the trade agreement review that's coming up this summer.
To make sense of it all, I think we need to frame this as a tale of two environments. On one side, you've got the United States, which is really locked in a strategy of what they're calling hyper-competitiveness. It's all about incentivizing supply and investment. And then on the other side, you have Canada, which these documents repeatedly describe as a high-friction environment.
Okay, so let's unpack hyper-competitiveness first, because a lot of this seems to hinge on a piece of legislation that passed last year with a very distinct name, the One Big Beautiful Bill Act. OBBBA.
You really can't make that up. Signed into law on July 4, 2025. It's a massive tax package, but for the real estate investors in these memos, it all comes down to one magic phrase: permanent 100% bonus depreciation.
Right, I see bonus depreciation highlighted all over these notes. It sounds like a bonus you get at the end of the year, but I know it's more technical. Can we get a plain English translation? What does that actually mean for someone buying a building?
Sure. So traditionally, if you buy a commercial building, say a warehouse, the tax code says you have to depreciate it or, write off the cost over a very long time, usually 39 years.
So you get a tiny little tax break every year for almost 4 decades. It's a slow drip.
Precisely. It's boring, and it doesn't really help your cash flow today. What OBBA did was restore the ability to take a huge chunk of that value, the qualified property, and expense it immediately. All in year one.
When you say qualified property, you don't mean the whole building, right? You can't just write off the entire purchase price.
Correct. Not the land or the building shell. We're talking about the guts of the building. The HVAC systems, the paving, the lighting, all the personal property inside. Sophisticated investors will do what's called a cost segregation study to break it all down. And, often 20 to 30% of a building's value falls into these buckets.
Okay, so let's run the math to see why this matters. If I buy a $10 million building and say $3 million of that is qualified property, what happens?
Under the old rules, you'd write off that $3 million slowly over decades. Under OBBBA, you write off that entire $3 million the day you buy it.
So I get a massive tax deduction right away.
Exactly. And what that does is it creates a huge non-cash loss. You might be making good money on rent, actual cash is flowing in, but on paper, you're showing a loss of millions because of this huge write-off. And that shields your income from taxes for the first few years.
So practically speaking, I'm an investor, I'm collecting rent, putting it in my bank account and paying zero tax on it because the government says I lost money on depreciation.
That is the mechanics of it, yeah. The sources here describe it as effectively getting an interest-free loan from the government. You're keeping cash today that you would have otherwise paid to the IRS. It just changes the entire math of the deal.
Which brings us to a term I love in these notes, tax alpha.
Mm-hmm.
Usually when we talk about alpha in finance, we mean you're smart.
Right.
You picked a better location, you managed the building better.
Right, that's operational alpha. But tax alpha is generating higher returns purely because the tax structure is more efficient. The building performs the same rent, but you keep more of the money. And when you combine that with a U.S. federal corporate rate of 21%, and places like Texas have zero state income tax, it's just a powerful engine for return.
Versus Canada,
Where the combined corporate rate is what, around 26.5%? But the rate isn't even the biggest problem, it's the leverage. The U.S. also restored something called Section 163J to an EBITDA-based calculation.
Okay, stop there. Section 163J. No jargon. Why does an investor care about that?
It's all about how much interest you can deduct from your taxes. If you borrow money to buy a building, you want to deduct that interest. The U.S. now uses EBITDA to calculate your limit. That's a big, broad number. It means you can deduct a lot of interest.
Which incentivizes borrowing more. It basically tells investors, go ahead, leverage up.
It supports higher leverage strategies, yes. Meanwhile, Canada has these restrictive EIFEL rules. They use a much stricter formula. So in Canada, if you borrow too much, you can't deduct all the interest. It becomes expensive. In the U.S., you borrow more, deduct more, pay less tax.
So that's the U.S. carrot. Tax shields, high leverage, low rates. Now we have to talk about the Canadian stick, the high friction environment.
And this is where the comparison gets, well, it gets really painful for the Canadian market.
Yeah.
The sources all highlight something called the land transfer tax, or LTT.
I saw the numbers on this. It's genuinely shocking if you're not used to it. I think most people assume you just pay a small fee when you buy a property.
Not in Toronto. In Toronto, you're paying a provincial tax, A&D, a municipal tax to the government. Combined, it works out to roughly 4.0% of the purchase price.
4%. So just to be clear, if I buy a $100 million warehouse in Toronto, I have to write a check for $4 million to the government just for the privilege of buying it.
Before you even turn the lights on. Before you collect $1 of rent. And the notes call this dead money.
Why dead money?
Because it generates zero return. It's not an investment in the building. It doesn't fix the roof. It doesn't get you higher rent. It's just gone. It acts as a circuit breaker on deals because it's a massive upfront cost you can't recover until you sell.
Okay, let's look at the head-to-head model here. This is the core of the analysis, a direct comparison. Class A industrial warehouse in Toronto versus an identical one in Dallas. 5-year hold. What's the verdict?
The verdict is a blowout. The model shows the Dallas asset generating a levered IRR, that's your return of about 10.5% to 11%.
In Toronto.
Around 7.3% to 8.2%.
Wow. So we are talking about a spread of, what, 240 to 340 basis points.
It's huge. In the institutional world, investors chase spreads of 50 basis points, a 300 basis point gap. That's an entirely different asset class. If I'm a pension fund manager, I can't justify taking a 7% return in Toronto when I can get 11% in Dallas for the same risk.
And to be clear, this isn't just because Dallas rents are growing faster.
No, that's the key insight here. Dallas wins largely because of that combination of bonus depreciation and low transaction costs. Closing costs in Dallas are about 1%. In Toronto, they're 4 to 5%. That friction just eats all the alpha.
It's a complexity premium. You're paying extra just to deal with the friction of being in Canada.
And here's the frustrating part, or it should be for Canadian policymakers. The analysis shows that if Toronto just removed that municipal land transfer tax, the IRR would jump by about 90 basis points. Immediately. It's a lever they could pull tomorrow.
But they aren't. And so the capital drifts south. But it's not just about profitability, right? It's also about liquidity. How easy is it to get my money out?
This is the next part of our dive, liquidity. The sources contrast fluidity versus sticky assets.
Fluidity sounds good. Sticky sounds like a problem, like stepping in gum.
It usually is a problem, yeah. The U.S. has this incredible tool called the Section 131 exchange.
The like-kind exchange. I've heard of this. It's been around forever, right?
Since the 1920s. It lets an investor sell a property, and as long as they buy another one fairly quickly, they defer all the capital gains taxes. It keeps the money moving. It encourages velocity.
So I can sell my warehouse in Dallas,
Yeah.
take my profit, buy an apartment building in Austin, and the IRS doesn't touch my gains.
Exactly. You're compounding pre-tax money. It keeps capital circulating. Now, compare that to Canada. There is no equivalent to a 1031. Every single time you sell a property, it is a taxable event.
So the government takes a bite every time money moves.
Sand in the gears, that's the phrase used here. It makes Canadian assets sticky. Investors are forced to hold on to them longer just to amortize those high transaction costs and avoid the tax hit. You end up with a stagnant market.
And on top of that, we have the foreign buyer ban.
Yes, the prohibition on the purchase of residential property by non-Canadians. It was supposed to be temporary, but as of now, early 2026, it's been extended all the way through 2027.
But does that affect commercial real estate? Or is it just houses?
Directly, it's residential. But the sentiment affects everything. It signals to the global market that, outsiders aren't welcome. It limits the pool of buyers. Fewer buyers means less liquidity. If you're a global fund, why invest billions in a country that keeps passing laws to keep you out?
So if I'm a global investor in London or Singapore, I look at the U.S. and I see tax alpha, I see interest-free loans from the government, high liquidity. Then I look at Canada and I see high friction, dead money taxes, sticky assets, and a government that seems hostile to foreign capital.
It's not a hard choice, and that is why we're seeing this great divergence. The capital flows where it's treated best.
But wait, here's where it gets really interesting. Because so far, it just seems like the U.S. is this unstoppable juggernaut. But there is a plot twist in the data.
The trigger event.
Right. We're looking at July 2026. The USMCA, the trade agreement between the U.S., Mexico, and Canada, is up for a joint review.
And this is the single biggest non-rate risk on the horizon. Everyone is watching the Fed for interest rates, but they should be watching the trade negotiators. The scenario modeled here is a full breakdown in the agreement. Maybe the U.S. just refuses to renew or imposes a 10% baseline tariff.
Okay, so a trade war. You'd think that would crush Canada and maybe help U.S., America first and all that.
That's the intuitive thought, but the model shows something surprising. A trade breakdown actually hurts Dallas.
Really, why?
The nearshoring thesis. The whole reason Dallas industrial is booming is because goods are flowing up from Mexico and down from Canada. It's a logistics hub. You put up a tariff wall, that flow of goods just stops.
So the warehouses go empty.
Or at least demand plummets. The model predicts Dallas rent growth collapsing from 4.5% down to 2.5% in this scenario.
Ouch. That kills your pro forma.
And cap rates, which measure risk, they'd expand. Basically, the U.S. interior loses its status as a safe growth market because the supply chain gets broken.
Okay, so Dallas takes a hit, but Canada must get absolutely hammered in that scenario.
It's a shock. The model predicts Toronto industrial values dropping 10 to 15%. Risk premiums spike. It's ugly. But, and here's the fascinating twist, it changes the flow of capital.
How so?
It shifts from capital flight to capital trapping.
Capital trapping, that sounds claustrophobic.
Think about it. If there's a trade war and the U.S. becomes hostile, Canadian money can't easily go south anymore. It gets scared, it gets defensive.
Defensive localism.
Exactly. So even though Toronto's economy takes a big hit, the industrial market might become a strange sort of safe haven, simply because domestic capital has nowhere else to go. The Canadian pension funds stop buying in Texas, and they start buying in Toronto again.
So the money is forced to stay home.
And that narrows the spread. The model shows the return gap between Dallas and Toronto shrinking from that massive 300 basis points down to just 57 basis points.
But let's be clear, that's not because Canada got better.
No, it's because everyone got worse. It becomes a race to the bottom.
That is a grim silver lining. Hey, at least our returns aren't that much worse than theirs anymore because we're all losing money.
It is not an optimistic scenario, but it shows how interconnected these markets are. The southern drift relies on an open border. You close the border, the drift stops, but the whole ecosystem suffers.
So we talked about money leaving, we've talked about trade wars, but there's one more drain mentioned in the sources, and frankly, I think this is the one that keeps CEOs up at night. The human capital drain.
The brain drain, because buildings don't buy themselves. People do. And the people who make the money are moving too.
And we are seeing a massive wealth gap opening up between professionals in the U.S. and Canada.
It comes down to the personal balance sheet. The top marginal tax rate in Ontario is 53.5%. So for every dollar you earn past a certain point, the government takes more than half.
And in the U.S.
In a growth state like Texas, the federal rate tops out around 37%, and then there's zero state income tax.
So you keep significantly more of what you earn.
You do, but the real magic is the compounding. One of the sources has this startling stat. Over a 10-year period, a high-earning professional in the U.S. can build a personal balance sheet that is 40 to 50% larger than their counterpart in Canada doing the exact same job.
50% larger. That's not just a nicer car, that's generational wealth. That's retiring a decade early.
Exactly, and that creates an irresistible pull. We aren't just losing investment dollars, we're losing the deal makers, the entrepreneurs, the risk takers.
But doesn't Canada have a departure tax? I've heard about this. You have to pay to leave, right?
They do. It's a deemed disposition of your assets. Basically, the CRA, the Canadian Tax Authority, pretends you sold everything you own the day you leave, and they tax you on the capital gains.
That sounds like a deterrent. A massive bill just as you're packing your bags.
It's meant to be. But the experts in these memos have run the math. They call it the exit tax calculation.
And what's the conclusion?
Even with the departure tax, the long-term math still favors leaving. The higher compounding in the US, that tax alpha on your personal income, makes up for the exit fee within just a few years. It's just treated as a cost of doing business.
That is sobering. It's essentially a subscription fee for a better economic engine. You pay the fee, cancel your Canadian subscription, and sign up for the American one.
That's a really good way to put it. And once that talent leaves, it very rarely comes back.
So let's wrap this up. We're sitting here in February 2026. What does this all mean for you, the listener?
Well, the summary is clear. We are in the middle of a great divergence. The U.S. has aggressively structured itself for hyper-competitiveness with OBBBA. They've lowered the cost of capital, they've incentivized risk, and they've lubricated the gears of liquidity with 1031 exchanges.
And Canada is struggling with friction.
High friction, land transfer taxes, complex rules, high personal taxes, barriers to foreign capital. Unless Canada pulls a major policy lever and the sources all point to removing the land transfer tax as the most effective fix, the math just overwhelmingly favors the southern drift.
It seems like the verdict is in. The money follows the math.
Always. Capital is agnostic. It doesn't have a passport. It goes where it grows.
So we'll leave you with a final thought to mull over. And this one comes straight from the expert nose, but I think it applies to everyone, whether you're a real estate mogul or just a taxpayer.
Yes. We often look at tax policy as just a way to fund governments, schools, roads, hospitals, a civic duty. But what if we flipped that? What if we viewed tax policy as a product, and specifically a product related to customer retention?
The taxpayer is the customer.
And capital and talent are the customers. In a globalized world, they have options. If they can leave, and we've seen they can, how long can a jurisdiction charge a premium price, meaning high friction and high taxes, for a product, the economy, that offers lower growth?
At what point does the customer just cancel their subscription?
Exactly. At what point does the regret risk of staying outweigh the cost of leaving? Based on the data we've seen today, for a lot of capital and a lot of talent, that point has already passed.
A lot to think about. Thanks for listening to this deep dive into the Great Divergence. We will catch you on the next one.